Hey everybody, happy Wednesday to you, and time for managing an options portfolio. My name is Brent Moores. We do this each week at this time, and I'm joined by Connie Hill in the chat. Appreciate Connie, and just realize you can always follow Connie and I on X, formerly known as Twitter, just for additional financial content throughout the week. So I appreciate you guys, and those watching live, we're glad you're here. I see some familiar names in the chat. That's wonderful. And if you're a first timer, we're grateful for you too. And if you're watching on a recording, that's great too. Hey, before I get too far into this, let me just mention a couple things. One, well, make sure you check out Connie's webcasts out there. Long verticals and diagonals on Thursdays at 11 Eastern time. She also teaches a straddles and strangles webcast on Mondays, which I think complements, both of those I think complement this webcast pretty well here. Hey, options do carry a high level of risk and are not suitable for all investors. Multiple leg option strategies will involve multiple transaction costs. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And rolling strategies can entail additional transaction costs. The paper money software application is provided for educational purposes only. And the material today is intended for educational purposes only as well. For the sake of simplicity, on these trades, I may not factor in commissions and fees. Just make sure you are aware of those when you trade. Schwab does not recommend the use of technical analysis as the sole means of investment research, although we will use technical analysis in this webcast. And all investing involves risks, including the potential loss of principal. Past performance is no guarantee of future results. Let's head on over to the Thinkorswim platform. Just take a quick look at the markets. S&P 500 up a little bit. And, you know, the trend is continuing. And I think that's an important thing because we're going to look at individual stocks as well. And of course, those stocks will be just examples. But one thing you notice on this is, you know, it goes up and then it kind of settles down, goes up and settles down, goes up. And that's no guarantee of the future. But a lot of traders may say, well, after we've had some upward momentum for a while, there's likely we may have a little bit of a sell-off. So as you're looking at your individual portfolio, you may consider the same sort of thing. So for example, if you're looking at a stock, and I have some stock here, and we're going to talk primarily about options today because this is managing an options portfolio. But sometimes you may consider option strategies based on the stock. Okay, so for example, covered calls. Are any of these stocks that I have candidates for covered calls? Well, I'll tell you, Delta Airlines isn't because I only have 50 shares of stock. And for a covered call, you need 100 shares of stock. But I have some where I have 100 shares or some multiple therein of 100 shares of stock. So what kind of, what do you, when you're looking at stock trades, there's some different considerations for it. So let's look at, we'll just kind of go down the list here at some of these stock trades and consider what kind of things we may do, because we may consider adding stop losses. But after a stock has moved up quite a bit, there's, I think, a feeling that it may hesitate a little bit there. So what we can do is we can then look to potentially sell a call option at a higher price. And if the stock happens to keep going up, then we end up selling the stock at the higher price. Now, that's kind of a bummer if we decide to sell a stock at a higher price and it just goes way up and we have to sell it for, you know, $150 or something like that. But if the stock doesn't continue this meteoric run up and it continues, it kind of pulls back a little bit for a little while, then we could take advantage of the time decay of a covered call on that. So let's take a look. That's the kind of thing we may consider on this. So for example, looking at Agilent here, what we're going to do is I'm going to look out and I'm going to go out, let's see, I'd say about a month. Well, there's nothing that's exactly a month. I can go out 9 days. That's pretty short term. Take advantage of time decay on there. I could sell kind of a wider spread, 35 cents. Let me go out 44 days and just take a look. These kind of have wider spreads on these. I'm not in love with these. Let's look at some other examples here. So the second one on our list was AVGO. Is AVGO, has it just shot up a long way? No, it hasn't really. It's kind of been going sideways. Now, one thing, I don't have a stop loss on this. So it's very possible I'll add a stop loss. Now, on all the stocks, I'm not going to spend the time to add stop losses on all my stocks today, just for time's sake here on this. But what I'm going to say is, I'm going to kind of draw my line in the sand on this. So this isn't an options trade per se. This is a stock trade, but just for completeness of conversation of things we can do for a stock, in addition to potentially selling a cover call, and we'll look at some other examples there, what I may do is I may look at potential stop losses here. So I'm going to say, look, if the stock breaks below here, I've had enough. I did this for a bullish trade. Right now, it's just going sideways for, since September, it's just been going sideways. If we break down, say, below 320, I'm going to decide to get out. And if I want to add a stop loss to that, I can just right click on it, create a closing order, and with stop, and we said below 320, stop, good till canceled. Let me just open this up a little bit here so you can see it a little better. And we said 320, below 320, or if you don't want to do exactly 320, you could do something just a little bit below that, 319, and then I can confirm and send. So the goal is to get me out if we go below 320 or 319 in this case. It doesn't guarantee we're going to get out at this. The stock could gap down and we could sell, who knows where it's going to sell. It turns into a market order if we do that. You could, if you like, do a stop limit order, but then you don't know if you're ever going to sell that thing. Let's look at, say, Bank of America. Well, Bank of America, I have a stop loss on it. We have earnings coming up. I'm going to hold off on that one just a sec. We also have earnings on Bank of New York Mellon. I do not have a stop on here. Let's take a look at it though. Okay. So here's Bank of New York Mellon. And if we look back at this, what do we see? We kind of see the same thing. It goes up and comes down. It went up a long ways that time, comes down, up. What's it going to do? I don't know. There's always the uncertainty of the earnings, but I'm willing to say, hey, what if the stock goes above maybe 125 or something? I'm willing to sell there. Let's see what kind of premium we can get on that, on a call option on that. So part of your options portfolio is looking at your existing stocks and considering whether there's a potential option trade on those. Here we go. Again, we kind of have the 9 days or the 44 days. I can go up to the 125 strike. Let me go 44 days here. Spreads are a little bit better than on the other stock. And I can get $1.85. So if we agree to sell this for $125, stock right now is about 121. We're agreeing to sell it for 125. So that would be I don't know exactly what percent, that works out to be like a 3% gain over where the stock currently is to sell it there. Plus, we'd also get another about 1.5%. Maybe we can get the mid price even on this or something close to that. On top of that, in premiums, we get to keep the premium. Okay. If you're not familiar with covered calls, you can always check out our Getting Started with Options webcast on there. But I can do that as a potential trade. Now, of course, here's the thing. We have earnings coming up. Okay. And that earnings, we're looking at about a $4.50 move on earnings, up or down. So I already have the stock. I'm already taking the downside risk on that stock. This would help to offset it if it goes down to this extent. Let's say we sold this for 180. Let's just look at the percentage on that. So if I take $120 and I do 180 divided by 120, gives me about a 1.5% return. In fact, that's exactly 100% return, 1.5% return. So it's going to help me to that extent. It's not massive help. If the stock drops by $10, it's helping me out to the extent of about $1.80 or something like that. But maybe it's worth it. If the stock kind of goes more or less in a range below my 125 level, then it's just increasing my returns. If the stock does shoot up above 125, I'm agreeing to sell it for 125. So that's the downside on this. There's no clear-cut trades here in the option camp. There's always pros and cons, but in my mind, that's maybe a risk we could be willing to take. So I'm going to click on the bid price on here, and I'm going to try and go a little bit better than natural. Let's try that 180 price on that. And I'm going to, we're going to sell it and confirm and send. And I'm going to, this should match up automatically with that, but let me just do that. And now when we look at this, I have a trade. I'm trying to take advantage of my stock portfolio with some extra income here. And it adds positive theta, time decay, almost $4 a day of time decay helping me out. So some people won't do that because of earnings coming up. You can choose on that if you like how you want to do that. There's other stocks. I could look at the same thing here on CNP. I'm not going to go through it. I'm not going to add again, this isn't what I'm looking for. What we're looking for here on this cover call is if we think it's gone up and about to come back down. In this case, it went up, but it's already kind of come back down. Probably not the ideal situation. I have a stop way down here. It looks like the stop may be too low. So I'm not going to take the time right now to adjust that stop, but putting a stop down here may make sense rather than where it's at, which is, where is my stop? It's down at $30. That's probably too low for this type of trade here. So I'll adjust that stop, but I'm going to do it after the webcast here. I'm not going to take the time on that. Let's look at one other here. Let's look at, say, Intel. Okay, let's look at Intel. INTC, here's Intel. Same deal. Potential resistance here. When's our earnings coming out on Intel? I don't know, to be honest. Let's go to earnings, Intel, January 20th. So it's at the end of the month. We have earnings on that. Could we do a cover call? Would it make sense? Does it make sense to think that the Intel may not continue up at the same rate it's been doing, that it may do something that it's done before? Maybe this is a resistance that it bounces off of, or even if it goes above, maybe it goes up and then comes back down and retests the support. I think those are reasonable things, ways of adding potential income here. Now, fortunately, Intel has some weekly options here, so I don't necessarily have to go out either 9 days or 44 days. I can go somewhere in between. Let's just take a look here. If I go 43 stock is at 43 strikes at the money. We're not going to hold it all the way to expiration likely, but I can go up to 45. How does that look on a chart? What's my delta on this? Let's just take a look at the delta. Delta is about 43 delta. Let me get a few more strikes here on this. Okay. If we go to about a 29 delta, that would imply roughly a 29%, 30% chance of it going in the money. If I do that, okay, if I look at that 30 delta, then I'm going to consider. Now, the delta tells me how much the stock is going. The option is going to move in relationship to a $1 move in the stock price, but it also gives us that kind of estimation, and that's all it is an estimation of probability. But let's say I got 125 out of that. Okay, 125 premium. Convert your premiums to percentage. Stocks at 43, 3 times 40 is about 120. In other words, this is about a 3% return over this time frame if we were to get the whole thing. Now, we have earnings. This is actually a day after earnings. We're not planning on holding it all that way. We're not going to plan on holding the option the entirety of that. But if the stock doesn't go up a lot, we can look to take advantage of that. If we want to get out before earnings, what we're probably going to see is actually those implied volatilities, interestingly, don't drop that much before that earnings date. Let me do this. Let's go out 16 days. I'm going to go to around a 30 delta. I can get a 2% return if we were to receive the whole amount. So that's about $90. That's roughly a $90 return on this. Okay. Stock's about $43. So that's how I'm doing the 2%. You see that? This isn't, my math isn't, I don't want to throw you with the math. Okay, I'm not a math whiz here. 43 cents, okay, 43 cents in the option price would represent about a 1% return. You see that math there? Stock's at 43 cents is 1% of that. I can do 2 times 43 in my head. Most of you can do that, right? So that's a little bit below 90 cents. So I'm getting about a 2% return over 16 days if I were just off the premium there. Now, that doesn't mean it's free money. There's risk. The stock could go way down. Well, I already own the stock. Okay, that risk is already there. The stock could go way up. Let's say the stock goes well above the $47 level. Let's say it goes up to 50. At that point, will I have wished I didn't do the cover call? Yeah. So if you think the stock is about to shoot way up, don't do the trade. But we're intentionally picking a time on this where we think it may pull back a little bit because we just had a big run. And when it's had a big run in the past, typically it's pulled back. So I'm going to do that trade here. I'm going to add in that covered call here on this. We're going to go to 27 delta. I'm going to click on the bid price. This is the natural. I may be able to get a little bit better than that natural price. So we'll go to about 86, we'll say 87 cents on that. I'm going to confirm and send, and we're going to turn this into a covered call. All right. I think that's all I'm going to do on that. Of course, you can go through your portfolio, consider those, paper trade those, and whatnot. When I'm looking at stocks, if it's shot way up, doing well, shot way up, and I think it may come back down, cover call may be appropriate. If it's kind of going sideways, reevaluate your stop losses. And then sometimes you may look at a stock, such as we have a stock, WRB, and you may go, look, I got in back here when I thought it was bullish. This thing has just turned bearish on me. I'm just going to get out of that thing. Okay. So that's where and you can see I'm losing a bunch of money on that. I'm just going to cut my losses because I'm not bullish anymore. The reason I got in this trade was, well, for it to be bullish. And that's not the technical forecast here on this. So I'm just going to confirm and send and get out of that trade. Okay. Now let's talk about some options that we can do. Some additional types of options. You'll notice in this kind of stock category, I have a couple things. These are trades that I entered last Friday. I entered them in our Condors, Calendars, and Butterflies webcast. If any of you are interested in that webcast, I put the playlist in the chat. If you're not interested, or if you're not watching live, or if you're not interested, don't click on it. If you aren't watching live, you can always go to the playlist. You're on Trader Talks channel on YouTube. You can go to playlists, just look for Condors, Calendars, and Butterflies. But what we talked about last Friday was synthetics, long synthetics. That's what this trade is right here. Okay. I have a long call. I have a short put. Same strike. In a lot of ways, it acts like a stock in terms of the profits and loss potential. There's differences, though. One difference, for example, is this expires. This one expires in March. Another difference is Bank of America pays a dividend. You want to get the dividend on this. But that's an example. That is an example of a long synthetic. Okay. Now, I've only been in a few days. We're going to stick with it as long as we're bullish on Bank of America. That's what we do. Now, in the chat said, yeah, hey, can we look at something? I'm not going to go through. That's not really the topic right now. I'm not going to look for new trades necessarily right now. But yeah, you look at that webcast I did last Friday. You're not limited. This is 72 days out. Can you do a Leaps synthetic? You can do a Leaps synthetic. Yes. Same deal. It's kind of, you're trying to take advantage of the stock there. Okay. Now, Debbie said, hey, we've got earnings. You're absolutely right. And we entered this full well knowing that there was earnings, and that's okay. Just like when you're buying a stock, this isn't intended to be a 1-week trade or 2-week trade. We're going to stick with this. The typical management of synthetics is going to be like that of the stock in terms of technical analysis. Now let's look at another one. We also did a synthetic. These are the two synthetics we did last Friday on Merck. But it kind of begs the question. In fact, here's your Leap synthetic that we just did. 345 days out. So let's look at Merck here for a sec. What's Merck done? Well, it went up, pulled back a little bit, went up. Could we potentially do it's not a covered call because we don't own the stock, right? We have a synthetic. We have a substitute for the stock, but it's not the stock. Could we do a cover? Well, we can't do a cover call, but we could sell a call potentially against this if we wanted to. Let's just double check earnings on this. Maybe I don't want to do it right before earnings. Merck, February 3rd. So we'll look to get out before that time frame on that. Let's look to sell a call here on this. Now, we already have a long call. We have a long 105 call that's out. That's that Leaps call. But I'm going to do a short-term call on this to try and bring in a little extra income here. Maybe. We'll see what looks appropriate. Let's go out 16 days. That's before expiration. Here's Merck. Stock's about 110 right now. Okay, we're right there. Well, I want to keep my probabilities lower, so I'm going to use that delta. I'm going to go out maybe to, what if we do like a 24 delta here? Okay. Maybe we do a 24 delta on this. Now, I'm getting about 70 cents on this. And from a percentage standpoint, if we own the stock, that's actually kind of lower than we'd normally look for. Now, we didn't pay, 100 shares of stock would cost $11,000 on this. It's a $110 stock. 100 shares of stock would be $11,000. But the synthetic, that's kind of the nice thing about synthetic is we didn't pay that for the synthetic, okay? There's still the risk on it, okay? You still have the downside risk, but one thing is you don't pay as much upfront. So in terms of that, the percentage actually looks a little bit better. So I can add that in there. Now, before I do that, let me just double check questions. Let's see. With synthetics, we don't get dividends, right? Correct. We don't get dividends on synthetics. That is true. So, and then second, is there a special threat during earnings season? Well, with synthetics, I'd say it's the same threat that you have with, to a large extent during earnings season as you do other trades. If we did, say, a true cover call, there can be more volatility in the market. when earnings coming out. Now, we're not planning on holding this through earnings, right? This is before the earnings date, but that's really the risk there. So we're going to be selling this. All right. This is for Merck right now. We're looking to sell this 24 Delta right there. Okay. So I'm going to add a short call to the mix. I'm just going to click on the bid price here. We'll split the difference between the natural price and the mid price. I'm going to confirm and send this. I'm going to put this here in that bucket and send that. Okay. Now let's look at what we have. Let's look at what we did. We now, in addition to, instead of just the synthetic, which was a LEAP synthetic, we also have a short call on this. We sold that for 73 cents. Okay, we sold it for 73 cents. What we don't want is we don't want the stock to go rocketing up higher than the 114 call. We'll have to wait and see. But it's a way of bringing in income along the way. It's not a huge gain. We've already done fairly well on this synthetic, up 400. It's unrealized, up $410 on this. But it's a way of bringing in a little extra money and adding some positive theta to the trade. Okay, just be aware on this. What I'm not saying is go out on all your synthetics or all your stocks and add cover calls on these. Just know the pros and the cons on these, okay, by adding that short call on that. All right, let's move forward to some other types of trades here. Okay, we added cover calls, we did synthetics. Let's look at some short verticals, how about? Okay, so BMY. We have a short put vertical, also called a bull put spread. Same thing. Bull put spread. We've got 16 days to go. On short verticals, typically, if we're under 10 days to go to expiration, we'll just look to get out. Okay. Well, we're not under 10 days to go to expiration. Typically, on short verticals, if we've made most of what we can make, say 80%, 75, 80% of what we can make, we're just going to get out. Well, we've done pretty well. You can see our profit loss here on this. We're doing fairly well, but we're not quite there. We can still make more on this. So as long as we're still bullish on this, we're going to stick with it. If we're starting to turn bearish, we're going to, cut the risk on that and just get out of it probably. So let's do BMY. BMY. Am I still bullish? I'd say I'm still bullish on this. Even if this settles a little bit, our short strike. I mean, we want the stock to stay above 53 is what we want. Okay. We want the stock to stay above 50. That's down here. I'm comfortable with that at this point. It doesn't make a guarantee. So what I'm going to do? Nothing. I'm going to stick with it. We still have some money, some meat left on the bone, so to speak. We're going to let that run. Okay. Let's go to Dow. Now, this is not a vertical. This is just short put. Okay, short put. Normally, we probably would have gotten out at this point. There's only 2 days to go on this. It's out of the money. The stock right now is at almost 25. The strike is 22. When we sold this up front with this short put, we said we were willing to buy it even if it went in the money. And if that's the case, we're just going to let it expire. If it expires over 22, it should expire worthless. Theoretically, short puts can be assigned at any time, even if they're out of the money. Realistically, it seems very unlikely that would be the case. And think about that. It wouldn't make sense for most traders to exercise this. Because what this is saying is, This gives them the right to sell it at $22. 22. Well, it's already, they could sell in the open market for their stock for $25. So it's highly unlikely it would get assigned early. But in any case, so I'm just going to let that go. Short put, we're willing to get called, assigned just in case it were to drop, but it seems unlikely, even though it's possible. Let's go to Microsoft. This is one that we rolled last week. And this gets a kind of a little bit more of a tricky situation when you're looking at it. Consider what the trade is. Same expiration. It's a short call vertical, right? We have this call. We're out of the money on this right now. The stock is at 488. If it stays below 497, we're in good shape. Now, we only have 9 days to go, but we're so using our normal rules, we'll likely close this. But I think for this, to give you just some perspective on this, on what we did last week, and I'm going to try and go fairly quick. If I go and just look at, what was that? That was Microsoft. We can kind of reconstruct that trade. Initially, I bought the 505 call for $590. Where is it right now, that 505 call? It's about 116, okay? So yeah, we've lost 480, 490 or something like that on this, okay? That's that. We also initially sold a call at 500 for 740. We bought that call back for 250. So that was about a $250 profit, so to speak, on the short, on the $500 call. And then we entered a 497 call for $315. And that was $315, and it's now $255. So we're up a little bit. So that made a little bit of money. By rolling down, okay, we rolled this, in other words, initially this was a 505, 500 short call vertical. Things were going pretty well. We rolled this 500 down to 497.50, bringing in a credit along the way. Okay, bringing in a credit along the way. So, so that's where this stands. But right now, we're under 10 days to go. We're going to follow the rules that we typically do in short, with short verticals. So I'm just going to exit this trade at this point. Right click, create a closing order, and I'm going to confirm and send, and we're going to send that. Okay, so we're out of that one. Fair enough. Now, question. Why we've made 98% of what we want on Dow. Why not take the money and run? We certainly could. The reason is we said when we were getting up front, if it goes below 22, we wanted to buy this anyway. So if it happens to drop down, we're happy to buy it. Now, another choice we have on this is we could roll this out if we wanted to. And I'm not going to do that right now because I want to get through some more different types of trades. But if you want, you could look to close and sell 22 put out for early February maybe. Or maybe sell a $23 put out early February, or a $24 put out early February, or something like that. You can do that. But the reason is that was what our original intention was. And if it drops down, we're looking to buy Dow stock anyway in that case. Okay? And yep, okay. Let's go and let's look at the RUT. So this is an index option. I don't do many index options in this webcast, but we only have 8 days to go on this. So 8 days. Let's follow our rules. We're gonna close out of this. Right click, create closing trade. I don't know what I just did. I think I clicked on the wrong thing. Right click. I clicked analyze. I didn't mean analyze. We're going to close that and get out of that. Okay. And there we go. Okay. Let's go to a different strategy here. Let's go to this. We've got a leaps call on Caterpillar. It's been doing great. Typically, we're going to roll these using our past rules. If we hit to about an 85 delta, well, we're just about there. I'm going to hold off on that because technically I said 85, and even though we're close, we'll look at that in a future week there. Obviously, that one's doing well. Okay. Warner Brothers. Now, this has been in the news. You know, they have competing bids from Netflix and Paramount. And so they've done fairly well. This is a long call trend trade, though. Okay. We rolled this, I think, already, if I'm not mistaken. We rolled this last week, I think, because it was looking pretty good. But wrong stock, Warner Brothers Discovery, WBD. Okay. And am I still bullish on this? I'm going to call this still bullish. The general trend has been up. We've plateaued a little bit on this. I don't see any reason to not stick with it here at this point. So that was our original intention on the trade. And there we go. Okay. So that's that one. Let's see on time. We've got time for just a few more. We're going to look at a variety here. Okay. I've got CMG, Chipotle. Okay. Chipotle. Let's see. What do we got? This is different strike prices, different expirations. Okay. So this is a diagonal spread. And so on this, sometimes these can be a little confusing on these. We're under 10 days on our short contract. So we may look to roll if we want to continue with this trade. But sometimes diagonals probably can be confusing. So take advantage of your Analyze tab. Click on Analyze and go to Risk Profile. And we're going to go to CMG because that's the stock we're looking at here. And just when you're looking at it, just make sure that you don't have any extra trades that you've analyzed in the past, because that will mess up the graph there. Because it doesn't matter if you were analyzing it, a month ago, it's still going to be there if you haven't deleted that. But we don't in this case. Current stock price is right here. So where's the risk on this trade right now? Ask yourself where the risk is. Well, the risk is this. The risk is if we go this way on this. If it goes down a lot, then we can go from good to much less good. And so there we go. All right. So in this case, I'm going to, in this case, as long as I'm still bullish, I can stay in this. We have a time decay element that's helping me out. Okay. And so I'm willing to stick with that right now, as long as I'm still bullish. If I'm not bullish, that's a different story. So let's look at this. Still bullish? I'm going to call that still bullish. You may disagree, but I've got a trend. I've got a 20-day moving average that's bouncing off of higher highs, higher lows. Now, Curious PT said, where can I find a set of rules? Look, I try and go every webcast I do, I try and go through the rules on these, okay? And just as a quick review, and so I'm going to stick with CMG here. Let me just kind of summarize, and I try and talk about different trades each week and talk about rules. With most options, with short components, okay, short call vertical, short put vertical, or a leg such as a diagonal leg that's has a short leg on it, or a calendar that has a short leg on it. When we get under 10 days, we're going to get out. About a week to go, we're going to get out of those, or roll. That's your choice, okay, on that. That's number one in terms of, well, not number one. That's one of the main management rules we're using in this webcast. Okay. Number two, when you enter a trade, ask yourself, is this a bullish trade or a bearish trade or a neutral trade? What's the original intention for the trade? If you're in a bullish trade and you look at the charts and technically, and I know technical analysis isn't the only way to look at things, but if you're in a bullish trade and it turns bearish on you, not just a day or two down, but the general trend of the trade changes, then you're probably going to look to get out. Vice versa, if you're with a bearish trade and it starts to trend upward, not just a couple days up, not just a few days up, but breaking major resistance, trend changing, then we'll probably look to get out. Similarly, if it's a neutral trade and we're no longer neutral on it, we're going to look to get out of that trade there. Okay. Those are the two biggest rules here. Furthermore, depends on the type of trade, but if we've made most of what we could potentially make on a trade, we're going to look to get out. On most trades, that means like maybe we've made 75% of the trade, 80% of the trade, especially like with short options, we're going to look to get out. On a calendar or a diagonal, if we've made, oh, I don't know, 30% of what we can potentially make on those trades, we're probably going to look to get out at that point too. So I cover these each week, not comprehensively, but I try and hit each type of trade or different types of trade each week and go through management for those. Now, if you're interested in looking at past webcasts, but here's the in the chat, I just put the playlist link for this webcast so you can look at past webcasts, past types of trades. Again, we try and mix it up here a little bit there. All right. Okay. I'm going to call that a day because I have 2 minutes to go. And I want to just remind everybody, please subscribe to the Trader Talks channel. If you like the webcast, click on the thumbs up. That gives me warm feelings inside when you do that. But I do appreciate you. Also, make sure you follow Connie and myself on X. Also, coming up next, we have trading price patterns. So make sure you check that out. Thank you each for joining me today. We'll be back next week. We'll look at different types of trades next week. Some of the same types of trades and maybe some different ones. We'll probably revisit the Nike trade here next week and the Coke trade next week probably as well. Everybody have a wonderful rest of the day, and we'll see you all same time next week. Bye-bye, everybody.